Ladies and gentlemen, welcome back for the sixth series of wealth management for working professionals. Last time we have covered something related to Warren Buffett's 12 principles he used for all investment decisions. Now, today we will start rewinding what was being discussed in the past. So, from there we will be starting. So before that, he says some very interesting, kind of a advice for all the investors. So I would like to touch upon it, and later we will start with the Warren Buffett way. So one of the very important principles which he suggests to everybody is to buy great businesses when they are having a temporary problem or when the stock market declines and creates a bargain price for outstanding franchises. Meaning thereby, see, identify one of the top businesses where you would in future to come would like to invest into and identify why they are good businesses, great businesses. Great businesses are those companies which have a fairly long successful run where they assure above average the so-called return over equity, and then they have a very better profit margins, and also they generate surpluses, and all the reinvestment surpluses dollar to dollar are more than what they are being invested, and rather they give you decent returns, and they have a favorable market conditions, or rather economics, long term economics. So these are the kind of businesses which you need to look into. And whenever you find, you just identify those companies which are into such kind of businesses, and also they are run by excellent management. And management is one very important thing where you need to bet on, because after all the decisions are managerial. The better the management, the better the company is. And a company per se will have its own institutional memory and also its own institutional wisdom, so to speak, and it has a momentum. Once the momentum is created by great founders, naturally that will be, percolating down deeper into in future to come. So that is the area where we all need to, look at and be more interested into. Next philosophy is stop trying to predict the direction of the stock market, the economy, interest rate, or elections, and stop wasting money on individuals that do for this living. So never try to predict anything, the direction in which a stock market is going, or the prices of the company in which you have invested is going, or the interest rate and its implications on your stock portfolio, or even the elections and what is the outcome, and if X is the outcome, then the Y are the group of companies which will grow, and if Y is the say Z is the outcome, and A is the group of companies which will grow. These all stop thinking about all these kind of predictions, and the world doesn't run by predictions. And you have to stop wasting money on such kind of individuals who do it for living. So better you get be away from any kind of predictors they may be market analysts or the news broadcasters or anybody. So better keep yourself away from them. Then then comes is you have to study the facts and the financial condition and the value of company's future outlook, and purchase when everything is in your favor. For this, you need to do a lot of background study with respect to whatever is given in their own financial statements, or whenever there is a general body meeting or an annual general meeting in which the management discuss a certain facts and financial conditions. And always be very careful regarding candor, that frankness of the management, and also be very particular about identifying when they are trying to lie, or when they are trying to misrepresent. Any of the managers or top managers, whenever they try to hide something or misrepresent something, that is a sure short recipe for failure, and there is an impending kind of disaster which is about to come. And time and again I have seen this particular trend. Whenever a top management tries to resign from a company, that is a time when you have to quickly, immediately, you have to remove yourself from those companies, and better to come out unscathed. And rather than trusting or believing your own fate or luck, and they never matters, and you have to be very, very ruthless, and without any emotion you have to take your own decisions. And next one is Warren Buffett claims that what I do is not beyond anybody else competence. That means whatever he is doing, anybody with a common prudence can do it. Only thing is you have to steadfast, have faith in your own principles or whatever is rational. And whenever you tend to, give way towards irrationality or foolishness, you tend to perform very badly. So better you stick to a certain guiding principles which are basic essential for you as an investor to be very successful. And finally he says that to invest wisely it is necessary to become aware of all temptations to behave foolish. You might have, maybe even in my past, in my past investment cycles, yes, I tended to behave foolish because at the time I was totally naive, not understanding how the markets behave, how your opponents, various players within the market behave. So once you understand all these things, you identify what are those foolish behaviors, and once you know, you unlearn all those things. Anyway, the problem is that we all have a history, but if we fail to understand and learn from our history, that is the biggest challenge which we as a human beings tend to, because we are all human, we are susceptible to emotions, sentiments, and many a times our behavior is highly irrational. So better to control your own behavior if you want to be a better investor. So there are there are around 12 principles with Warren Buffett generally follow steadfastly in all his investment decisions, whether it is a small or big. He generally thinks investment not as an investment into a stock. He thinks every investment as investment into businesses. Business in totality is what he look forward to and he will look into. So, what are those yeah, tenets? The tenets are divided into four types. Number one is business tenet. Second tenet is the managerial tenet or management tenet, which is the most important guiding principle. Then the third is the financial tenet, and fourth is the so-called value tenet. And all four tenets are highly useful, are very, very important while making your own decisions. These 12 tenets are already discussed in the previous session. However, I would like to reiterate because these are the fundamental things which one has to keep in mind. Even if it is repetitive, I would like to again reiterate it. Like the first business tenet is the business simple and understandable. As we have discussed in the first two case studies related to Washington Post and also the Geeko uh, insurance company. So he understood the entire dynamics of that, both the businesses, both insurance business and also the so-called newspaper and information, the broadcasting businesses. So he tried to understand how whether they are simple or understandable. See, whenever we need to understand, we all have a kind of a circle of competency or the zone of competency. We all are competent in the areas where we have worked. right? The more experience, either through learning or through your own experience, that is the area where you will be naturally, having a zone of competence. This is, the Philip Fisher has given this postulate, or rather the principle, in which you have to understand what is your area of competence or circle of competence. And if you go beyond a circle of competence, he observed in his own investments, whenever he went beyond his circle of competence, he failed into it. So, what is essential and very important is the business simple and understandable? If the business is very complex, complicated, though we may tend to feel having a kind of a comfort understanding it, but if you don't understand totally and completely, then it is bound to, give a kind of a wrong results, because you tend not to understand everything, and there are certain complications or complexity within the business which you didn't understand. Probably that is the area where, the business will keep hitting you, and you will not understand. Finally, since you don't understand, you tend to take a wrong decision. So be very careful whenever you are investing into any business. You need to understand whether the business is simple and understandable. If it is not simple, then better not invest. If you don't understand, better don't. So this is the first principle. Principle number two: does the business have a consistent operating history? So you need to know, when did that particular business started, and is it consistently growing company, or are there any spurts, or are there any time when the business is not doing well, or it was, it has a checkered history where it has, some certain periods when it became dormant, or it was going into the losses. So you have to look into its history, and unless you have gone through the entire of the history, there is no point investing into it. For that, you need to go through all its so-called annual statements or annual reports, and you have to understand how it was growing, whether it was a continuously growing venture or not. And for this, you also need to understand the companies. As I said in the past, you have to go through the theory in which company is also organic growth of a company. Just like human beings or living beings, companies, the companies are born, and they also die like human beings, depending on how it is being nurtured, how it enters, and how the management is, whether they are into growing segment, whether, though the company may be professionally managed and doing exceedingly well, however, if the economic long-term economic impact is adverse, naturally they are bound to die. So you need to take into consideration these aspects when before you enter into it, and don't enter into those industries or companies which are at the stage of declining, declining stage, or which has reached maturity. Maturity is okay, but when it comes to a stage of maturity, you have to be very choosy about trying to pick up kind of industries. The industry in the matured stage will go for consolidation. Like the best player will always try to acquire so other players which are not doing well, and so that they keep on increasing their market share. So in that process, because they are eliminating so many competitors, they can survive. One, increasing their market share. Two, because they have eliminated competitors, they can also price in an advantageous way, whereby their profit margins, return over equity, all these things keep on increasing. Then the third most important principle is that, does the business have a favorable long prospects? For this, you need to understand the company life cycle, and then the product life cycle, which I have explained in the initial stages, initial, session. First two sessions, I have explained more about the business life cycles, wrong prospects, and you have to be very careful in picking up the companies which are poised to remain for say 10, 20, or 30 more years to come. And you have to avoid those companies which are especially in the area of technology, where technological life cycle keep on changing. And of late, especially the information technology and all these kind of things, they have some limited life cycle. As we have discussed in the past, radio as a technology is totally wiped out once television has come into existence. And when it comes to television, especially three companies, Sony, LG, and Samsung, they have reinvented, and they have discarded the outdated technology called as cathode ray tube TV to LED. Initially, it is LCD, then from LCD to LED, from LED to QLED and OLED. So they have continuously remained relevant despite a lot of competition from television, sorry, computers, laptops, tablets, and mobiles. So you need to find, the company should find relevance, staying relevant within the market, and they have to keep on changing. They have to invest a huge amount into R&D, and we all have to see how effectively the company could juxtapose itself within this particular market position. And then fourth tenant, managerial tenants, there are three, and these are one of the most important tenants which we all have to keep in mind, because it is the managers who either make or break the company per se. Even the best of the best company, if it is managed by the worst of the worst managers, it is sure shot a recipe for disaster and a failure. And we have seen in global and also Indian context, like mismanagement with the managers, be it Enron, be it WorldCom, or be it Satyam, Cox and Kings, and so many other GTB, Global Trust Bank, then your Yes Bank, all these companies, whenever the managers went overboard and did some sort of manipulation, naturally it led to a lot of erosion in the value of the company. And also company, at times in the extreme cases, they went bankrupt and they are totally out from the business. So you have to be very careful about it. So these are the three managerial tenets. Number one is management rational? Is management applying the principles of rationality instead of being irrational, doing kind of decisions based on not studying properly or understanding the actual dynamics of the business, or they don't have enough information, or they don't have enough capability to understand the real problems are. And then they are trying to react to every kind of adverse things, or they are not understanding the competitors properly, or they are not understanding the forces of competition, which I have tried to explain in the five quotas, five forces. Maybe probably in future to come, I will take up a complete session on that, because that is a very huge area which we need to understand. That I will bring it up when I discuss something related to economic modes. Then they are behaving irrationally, especially they are very temperamental, or they are bound by certain emotions and sentiments, and they get carried away by all these things. So this is one principle which we need to be very very careful about. Then the second principle, which is most important, we all have to keep in mind, is management candid with its shareholders. By this, it means that is management very frank and honest in admitting about their performances, their actions. At times, they may take wrong decisions. Also, we are all basically human beings, so we tend to make errors. Whether the management is frank enough to admit their errors, this kind of a thing you keep on finding with Warren Buffett. Whenever he understood that he had committed a mistake, he always said yes, he made a mistake, and this is and he asked shareholders to pardon him. And this is a kind of a frank behavior that basically, uh, you can say, increases the trust among the shareholders regarding the management and their competency. And always be very careful about looking at the competency of the managers. Are they good? They understand the business well? Are they taking right kind of steps? Are they very, candid and frank when it comes to informing you? Especially you find this particular thing when things are very good, everybody tend to be very frank because there is nothing to lose and everything to gain. And then whenever the company is in bad phases or bad patch, which usually it happens because the businesses are subjected to markets, and markets may go positive or negative depending on the cycles of businesses. So when they go negative, it is very very much essential how the management behave, or indeed uh, discuss or communicate with the shareholders. If you find them to be very frank, admitting all the issues and all the problems they are encountered and all the decisions, if they happen to commit a mistake, if they admit it, then you mean to say that they are basically admitting their mistakes, and that is a good sign. And many a times you don't fall victim to those guys who always try to cook up the balance sheets or profit and loss statement, or try to give only the positive information and try to hide all the negatives, and even though they are aware. So that is a sure shot recipe for disaster, and more or less in a very short time to come, or time to come, the company is bound to totally fail or collapse. So you see, be very, very, very careful about this particular principle. Then the next is, does the management resist institutional imperative? By this, it means that whether are they getting, you know, tempted to do certain irrational decisions. Like suppose a company has got a lot of cash flows, and they got a huge amount of money in the form of, say, suddenly they won a particular court case and they got windfall gains or huge amount of money as a compensation. And they take a right kind of a decision investing into right kind of area? Many a times they will be tempted to go into an unknown chartered unknown territory, and then they may lose whatever the business or the value a company is generating, and they may enter into a particular geography which they know, or the predecessors might have felt that they are highly risky and not worth investing. For example, Geeko, having been into business with an objective to only go for risk-free kind of a, the insurers, especially they were only into the segment where they insure only government employees. From then they went into the risky kind of a, insurers like or car drivers, like blue collar workers, then youth and unemployed. So they later entered into a huge amount of problems, because one is that the premiums are not adequate enough to take care of the claims at the later stage. And the second thing is the reserves they kept for clearing those such kind of claims are also much below what is being required. So Geeko went into losses and they suffered, and the company eroded from seventh position in United States of America to 34th position before managerial change, and then the management bringing in the prudent and rational principles. So till then they were very much suffering. So understand this particular thing and see in which direction the management is going towards, and always be very very wary about these kind of a things, what kind of a decisions they are taking. Now the next set of principles are related to finance, In finances, it is the first principle is what is the return on equity. Return on equity is nothing but the earnings of a company after before basically it is before interest repayment and the taxation. This is the core. Yeah, you can say the earnings of a company. So if the return over equity is more than say a risk-free rate in Indian context, it is 7.2 percentage. If it is more than 7.2 percentage, then the company is worth. And in any case, since you are putting equity being a risky kind of investment, as we have discussed in the third session, risk and return. So if you happen to understand that the company is risky, sorry, the investment is risky, you naturally want to have a premium. So the premium over the risk-free return is what CAPM model talks about. So you need to have a risk premium. So what is that risk premium? In case of equities, it is anywhere between 3 percentage to 7 to 8 or even 10, depending on the company, what kind of a company it is into, and whether the company is into high risk and high return kind of a company, or it is a very stable kind of a company. It all depends on it. So what is important here is, since you don't know the kind of what will be the ideal return on equity, what you have to see is you have to check whether return on equity given by this company is above its industry, within that industry compared to its peers. Is it above average or not? You need not have outstanding company, because it's very difficult for every company to remain, sustainably at a particular high, the so-called return over equity. So they may earn it in spurts in certain conditions, but not in all conditions. But what is important is you need to understand the company is giving you above average returns over equity compared to its peers. This is the next principle. The next principle is related to company's owners earning. Company's owners earning is basically the earnings by the company. It's basically a net income after taking care of all the expenses, whatever is left out, even after depreciation, amortization, operational expenses, then administrative expenses, taxation, then your interest payment. So whatever is left out, that is the owner's earnings. Owner's earnings can be used in two ways. Either give them a dividend, or you use it for reinvestment. Reinvestment is basically to cater to the needs of OPEX, operating expenses, which is called as working capital expenditure, or the so-called CapEx, capital expenditure, which is for expansion or capacity increase, or to replace the existing, outdated, obsolete machines and tools, or machines and plants. So any company which is trying to expand will always give you better returns, except for those companies where the scope for expansion is very limited. So next is, what are the profit margins? Profit margin is nothing but what is the profit compared to, it's basically a percentage or a proportion over sales value. Okay. So whichever company gives you better profit margins, they are basically are having a better economic mode, and because of the sustainable competitive advantage, they generate such kind of a profit margins. So you need to have those invest into those companies which have better, above average profit margins, and also those companies where the profit margins are improving. So next is, has the company created at least $1 market value for every dollar retained? So this is a very, very tricky and challenging, thing. Like, you need to check a lot of details of that particular company since last many years, maybe 10, 20, or since its beginning. So what it means is, a company that has reinvested again into the business, they should generate more than what it has reinvested. Suppose it has reinvested 100 crores. If it fails to give returns of more than 100 crores, then it is a loss making company. And that loss making may be unsustainable in the long run. And it may, at one stage, may lead to even bankruptcy as well. So you have to be mindful. And good and successful companies always have given a positive, you can say, returns compared to what they have invested in the form of retained earnings. So next tenant, which is very important, is the value tenant. What is the value of a company? Value of a company is basically an intrinsic value, and many times we tend to have a kind of an we tend to confuse value with the price or current market price of the company. But that is not the truth. Truth is value of a company is based on a simple formula. There are three different, three, you can say, uh, uh, there are three ways of calculating it. One, when the company is growing and you are not very sure about whether it is growing at a constant rate. So the simplest value calculation is cash flow of the current or the during the current year. With that of, you have to divide it by a factor called as risk free rate. So that will give you the value of the company. And in the second scenario where you find a constant growth, and the constant growth is less than that of the risk free rate, then the value of the company will be changed to the cash flows into 1 plus the percentage growth. Then you divide it by the so-called rate or risk-free rate minus the growth of that particular company, the constant growth. And this is the second. And the third scenario is uh, in which a company is growing much more for the next 10 years, much more than the risk-free rate, and that is split into two stages. You have to calculate twice, and that calculation I'll just show it all three things valuation techniques. I'll be just showing very shortly. I made a Excel sheet in which I will show you how those things are calculated. And then 12th and very important principle is that can it be purchased at a significant discount to its value? See, this particular thing has its own, you can say conditions. It's not that it is sacrosanct rule. Many a times you tend to pay more for an excellent company. It may sound to be paying more than what its intrinsic value is, but however, unless you make a calculation of the future the cash flows the company generates, till then you won't be knowing exactly what is the value it is giving. So I'll show you when it comes to Coca-Cola case study, in which this calculation is being made. Many a times we tend to think that there is an overpayment because the actual value as per the calculation is X, whereas it is you have given a premium price. Whether it is a premium or not, that can be calculated. That will be shown when we are discussing about the Coca-Cola case study. So let's go to the case studies. Geeko and Washington Post is already over, and we are now going into Capital Cities case study. Capital Cities is basically a company which is into news business. It is formed in 1954 by one business manager come a journalist. No, sorry, by a journalist and his business manager. Journalist is Lowell Thomas and his business manager is Frank Smith. They, along with another group, a few group of associates, they brought one company called as Hudson Valley Broadcasting Company, mm, which had included Albany, New York television, and also AM radio station. At the time, Thomas Murphy was a product line manager of at Labor Brothers. The Frank Smith, who happened to be the business manager of this, founder, he had a golfing partner who is Murphy, Thomas Murphy's father. So through him, he come to know about the younger Murphy, and he put him into the charge of the television company. And in 1957, Hudson Valley purchased Raleigh Durham television station, and the company's name was changed to Capital Cities Broadcasting, reflecting both Albany and Raleigh being capitals of their respective states. And in 1960, Murphy hired Dan Burke to manage Albany station, and this is a game changer. Burke was the brother of Murphy's Harvard classmate Jim Burke, who later became chairman of Johnson and Johnson. Dan Burke, being a native of Albany, was left in charge of the television station, leaving Murphy free to go to New York, and then from there he operated the entire operations of this company, and he was later named as the president of the capital cities in 1964. So, with that began one of the most successful corporate partnership in American movies. So, during next 3 decades, Murphy and Burke ran the capital cities, and together they made more than 30 broadcasting and publication acquisitions, and most notable of them is the purchase of ABC, American Broadcasting Corporation, in 1985. Buffett first met Murphy in late 1960s during a luncheon organized by Murphy's classmate. However, Murphy has offered, impressed with the Buffett, he offered a place in the board of Capital Cities, which he declined. But despite declining that offer, they were in touch, and they remained very close friends. So Buffett first invested into Capital Cities in 1977, unexplainably but yet profitably, but he again sold it immediately after that year. So in 1984, December, Murphy approached Leonard Goldenson, the chairman of ABC, with an idea of merging both the companies. However, it was being rejected by Goldenson, uh, and then again in 1985, the Murphy again, contacted Goldenson with an offer. This time, because Federal Commission, Communications Commission, which happened to be the so-called regulator, it has allowed companies to increase the number of television and radio stations that a single company can own from 7 to 12 with effect from April that year. That year means 1985. So this time Goldenson agreed to the offer, not because he had a love for Murphy or love for the company, but he had an internal crisis within the company because he found none of the candidates are suitable for leadership role. So finally he had to agree because he felt Murphy and Burke are the best managers in the media communication industry, and the company will be going into a very able and strong management hands. So this is the decision which has transformed. So right now, American broadcasting companies then entered the negotiation room with high price market bankers. Murphy, who always agreed, mm, Murphy together they worked out first ever sale of the television network and a largest media merger in the history up to that point. So, Capital Cities offered American Broadcasting Corporation a total package worth $121 per ABC share, 118 in cash, and three in the form of 1/10 warrant to purchase capital shares worth rupees 3 per share. So the offer was twice valued at the time compared to ABC, which was prior to the announcement of that. To finance that particular deal, $3.5 billion are required, and the capital cities would borrow up to 2.1 billion from the banking consortium, whereas the balance is to be either through sale of properties, which he did, around 900 millions through he was through by selling overlapping television and radio stations which are worth 900 millions, so that number of television stations are more, and this acquisition will help them to expand their businesses. So and also they have sold certain cable properties to Washington Post company. And the launch, the last $500, whatever the left out the portion, is funded by Warren Buffett through his company Berkshire Hathaway. And the newly they purchased around 3 million yeah, newly issued shares at a price of 172.75, which is 50% over what the offer is given to ABC, which Buffett agreed, and later he joined the board as a director. So now comes the rest of the tenants, whether the business is simple and understandable. See, for that, uh, Buffett, prior to purchasing this particular company, he had more than 10 years of experience managing Washington Post company, which we discussed previous session. And Buffett very much understood the business of television, broadcasting, newspapers, and magazine publishing, and he know all the nitty-gritties. Apart from that, Buffett's understanding of television network grew with Berkshire's own price of ABC when they did it in 1978, again in 1984. So prior to this acquisition, he is very well aware of the nitty-gritties of of this entire of the business, and he understands it. So there is no question that he don't have any understanding, and he felt it to be simple and very understandable. Now, coming to the next operating tenant, whether they have an consistent operating history. This is very, very important. I think we all have to keep in mind. Both capital cities and American broadcasting companies had profitable operating histories dating back to, say, some 30 years. ABC averaged 17 percentage return on equity and 21 percentage debt to equity in 1975 through 1984. Whereas capital cities during the same period, they had an average return over equity of 19 percentage and 20 only 20 percentage debt to equity. So both are more or less comparables within the industry segment, and that is one of the reason why Warren Buffett has picked up this particular share. Go through the next tenant, the favorable long-term returns. So, broadcasting companies and networking companies are blessed with above average economics, like newspapers, and for much of the same reason, they generate a great deal of economic goodwill. And once broadcasting tower is built, reinvestment and capital reinvestment and working capital needs are very, very minimal, and inventory is almost non-existent. So movies and program that can be brought on credit can be settled when the advertising income keeps rolling into the company. And as such, general rule, broadcasting companies produce above average returns on capital and generate a substantial cash in excess of their operational needs. Generally, there are risks also in this business. What are those risks? Number one risk is government regulation. Government regulation may be adverse to the companies which are into it. Then the second is the changing technology with the change, like at the time it was an era prior to internet. So internet was very much was there, but at a low level. So and then the changing technology, the kind of clarity, and then the kind of new stuff keep on changing in this particular industry. Then there was a shifting of advertisement dollars. Like there were so many alternative medias that has come into existence, and you in an economy, advertisement, whatever the budget is, very much limited, and that limited budget is distributed amongst all kind of media, and that is how companies do generate do pump in the advertisement budgets, and that since the kitty is very much constant, that used to be distributed amongst the media companies. So government can deny any renewable of companies broadcasting license, but generally it is rare because they don't want to bring in uncertainty and keep things in a very bad shape. And since America is a very fairly very good country when it comes to the so-called business laws and all, and the government is very much pro to the businesses, so they generally don't resort to this kind of a thing. But yes, maybe in other countries, this may be a problem. Cable programs in 1985 were basically they entered into the market. They were a minor threat, but not a major threat. And then most of the people prefer to view the television rather than the cable network. And in 1980s, advertisement dollars for free spending consumers were growing substantially compared to countries' GDP, because that is the time when there was a lot of buzz about globalization, liberalization, and privatization. So that was a time when MNCs from America have started migrating to, or rather, they shifted most of their operations to rest of the countries, like rest of Asia, India, Indonesia, and so on and so forth. So, and also the not only production lines, but also they started capturing most of the markets in the developed countries. They be it Latin America at that stage and Europe, and then later into Asia. So they were in an expansion spree. So to reach mass audience, advertisers still counted on network broadcasting, and the basic economics of network and broadcasting companies and publishers were in Buffett's mind above average. And in 1985, the long-term prospects for these businesses are highly favorable. So this is a nutshell about favorable long-term prospects. Now comes is how do you determine the value? And Berkshire Hathaway at the time have invested $500 million. To be precise, it is $517 million, and which happened to be the single largest ever investment ever made by Warren Buffett. So many people have questioned the prices at which he purchased at. Murphy agreed to sell Warren Buffett 3 million stock at the price of 172.50 per share, which is almost 50% premium to what he has paid for American Broadcasting Company. But anyway, the price and value, as I discussed in the past, are totally different. Then in this particular example, in this and then the next case study, I'll show you how to find out value in three scenarios. Scenario one, when the company is growing at a constant pace, and then in the second scenario, when it grows with a constant growth rate of growth, and the third scenario, when it is split into two periods. In one period it is growing much more than the rate of risk-free returns, and in another period it is growing at a pace which is less than rate of risk-free returns. So this we will calculate during both the case studies. Now let us see the case as such in this particular case. Like Buffett has purchased around 3 million shares at the rate of 172.50, and whereby it's at the rate of 10 percentage, which happened to be a risk-free rate based on the approximate yield of 30-year US government bond in 1985. And if you multiply the value by 16, you get to know what is the value of that particular company, which is for having such kind of a value, the company needs to have an earnings of $275 million. And Capital Cities in 1984, after depreciation and the capital expenditure, it had a operational surpluses of $122 million, whereas ABC had $320 million, making the combined earning power $442 million. Whereas they already, as discussed, they had a debt of $2.1 billion, which would cost them $220 in terms of interest. So the net earnings of the combined company was approximately only $200. So now let us see what is that, how do you calculate value in this particular company. But again, before that, we need to have certain considerations. Why Warren Buffett has picked up this company? And the number one is he bet on Murphy's reputation of improving the cash flows of the budget, the businesses. The operating margins when for capital cities at the time was 28 percentage, whereas for ABC it was just 11 percentage. And since it is taken over by Murphy, uh, Warren Buffett assumed that even if he increase it by one third, it becomes 15 percentage, and then 15 percentage may lead to increase in additional $125 million every year, whereas the combined earnings would increase by somewhere around $225 million annually. So the average uh, per share value of the company's earnings would be somewhere around 325 millions, with 16 million shares outstanding, and which would be discounted at the rate of 10 percentage, as we have discussed. In 1985, the 30-year government US government treasury bond was at the rate of 10 percentage. And then they calculated that the value per share, that is intrinsic value of the share, is somewhere around $203 per share, which is around 15 percentage margin of safety. And now let us see how it is being calculated. So I made a calculation sheet. So if we see, this $325 million is basically the earnings of the company, and number of shares outstanding are 16 million. So earnings per share would be, naturally, it will be 325 million, 325 divided by, since shares outstanding are also in million, so divided by 16, so it's coming around 20.3125. So now, since the discounting factor, the formula for discounting factor is the cash flow divided by the ratio. So here the cash flow is nothing but earnings per share. So if the earnings per share is 20 point 3125, you have to divide it by 10 percentage, which happen to be the risk-free rate. So it will be yielding 203.125. So this is the value per share with the 10 percentage discount. Now let us see, this is how it is being calculated, and what is the offer he has paid. Warren Buffett has paid only 172.5. So let us see what is the margin of safety. So now you take 203.25, right, minus, you just take it, deduct it from this, and then divide it by 203. So it is around 15.05 percentage, which is exactly what they have calculated as 15 percentage margin of safety. So 203 is the uh, per value per share, which we have derived here in this case, 203.125. So now let us go to the next. So apart from this, what is the view which Warren Buffett has carried? He assumed that he very well know about the business of newspaper, magazines, and televisions. He assumed that this particular business will grow forever at the rate of 6% annually, and without any need for additional capital, because in the process they will become a debt-free company, since they hardly had any kind of a capex. So whatever the depreciation will be equal to the capex, capex would be almost zero. So whatever the expenditure is, only depreciation rates. So now, based on this particular calculation, they have calculated. They found out that this particular value 203, it's not 203, but it is 507. So let us see how that particular thing is to be calculated. So here intrinsic value of the company, when the company is growing at the rate of a constant growth, then the formula changes. The formula is cash flow divided by rate of growth minus, risk-free rate minus growth. So here, cash flow is nothing but this is the cash flow. Now, you have to divide it by the risk-free rate is around 10 percentage. So 10 percentage minus what is the constant growth? Constant growth is 6 percentage. So if you apply this formula, the value of intrinsic value of this company is 507.125. This is what exactly is shown, calculated in this particular thing. And then they have arrived at 66 percentage as a margin of safety. So let us see how the margin of safety is arrived. Here I have calculated it again to show you. I'm just making a calculation. So let us take this 507 minus the amount at which he purchased divided by the intrinsic value. So the margin of safety is 66 percentage. So he has purchased at a discount of 66 percentage of the actual intrinsic value. So it is one of the best bargains one can ever have. So this is how they have derived at 66 percentage. So this is how you have to make a calculation. Let us now go to the next slide. So this is in nutshell about it. Now let's move to this. So institutional imperative. Institutional imperative, as I discussed in the past, it is all about not taking any foolish decisions based on provocations. Like, see, in this case, Burke and who is that guy, Murphy, they managed the company so well and generated $2.3 billion in unencumbered cash. This is the time when most of the managers are tempted to go for either wasteful expenditure or to go into a territory, uncharted territory, where they tend to lose a lot of money, and then that wasteful expenditure lead to blockage of not only capital, but since they have acquired certain businesses and also assets, it will lead to certain maintenance costs, which will increase the fixed cost. And at the same time, they keep on depreciating. If they don't generate enough surpluses, that will be a big loss making, and the entire amount whichever is invested is totally badly blocked, and it will not be any business parlance, or in any kind of it's not at all said to be fiscally prudent. So such sort of a decisions which usually managers are tempted to, but in this case Murphy did not enter into. He wanted to purchase certain properties for expanding their businesses, but however he is so stingy that he do not want to own any property that may lead to difficulty uh, uh, difficulty in maintaining it, and also he don't want to pay more amount, and he's very much, he had a kind of a knack that he don't want to risk shareholders, which he found it to be unacceptable. So what is the core principle or the philosophy behind both Murphy and Burke? They realized that the media business was cyclical, and if a purchase was built on too much of leverage is nothing but taking loans, then the risk to the shareholders would be unacceptable. Murphy never did a deal that either of us thought was capable of mortally wounding us. This is what Burke said about Murphy. A company that generates more cash can be profitably reinvested in its business, can buy growth, can reduce leverage, and can give a return to the shareholders. Since Murphy was unwilling to pay high asking prices for the media companies, he generally choose instead to reduce the leverage and buyback. So that was one of the wisest decision he has taken, because the excess cash is now deployed to improve the financial position, whereby he is reducing the leverage so that the company need not pay interest charges in future to come, and also purchase the stock, whereby increasing the value for the investors. So in buyback of stock. Okay. In 1984, after acquisition of ABC, the total long-term debt has increased to 1.8 billion. So the debt equity ratio was around 48 percentage. So the cash equivalent was at the time in 1986 was somewhere around 16 million. By 1992, long-term debt got reduced to 964 million, whereas debt equity ratio dropped to 20 percentage from 48.6 percentage. Furthermore, cash and equivalents increased to 1.2 billion from 16 million. Huge improvement, huge improvement, and making the company essentially totally debt free. And Murphy's strengthening of Cap City's balance sheet substantially reduced the company's risk, and that has enhanced the value for its shareholders substantially. That is the reason why Warren Buffett has chosen to take this particular company's stock. And let us see the $1 billion premise. And in 1985 to 83, 1992, market value of Cap Securities ABC grow from 2.9 billion to 8.3, almost roughly, 2.5 times increase within a very short span. And during the period, the company retained somewhere around $2.7 billion in earnings, creating around $2.01 for every $1 investor, which is somewhere around 100 2x. See, it has given somewhere around 14.5 percentage compounded annual return. And the investment which he made was just 517 millions. It rose to 1.5, giving him compounded annual return of 14.5 percentage, which is better than both CBS and Standard and Poor 500 index. So this is a nutshell about this. That too, where after the company suffering a cyclical downturn in 1990 and 91, and that has hit the intrinsic value of the company. So let us see the tenet of rationality. See, the rationality is basically, see, the approach taken by Murphy and Burke is that they wanted to go for repurchase of by outstanding buyback stocks. That through buyback of stocks, around 2 million shares are being, which is around 11 percentage of the outstanding stock, is being purchased. And we always need to understand the logic behind buyback. Buyback, you have to go only when the intrinsic value of the company is more than the market price of that particular company. If the market price is lower than the so-called, higher than the intrinsic value of the company, you should never resort to buyback of shares, because one, you are spending more than what is needed, more than the value of the company. Two, that excess cash is totally wasted. That could have been used for better, generation of profits, or to reinvest into expansion of the business. So never resort to that, and always check whether the buyback is basically, is it really better, or it's a bad decision based on the parameter which I have given. So you need to calculate the intrinsic value of the stock. Then you have to see what is the current market value, and if the current market value is lower than the intrinsic value, if a company announces buyback of shares, then definitely you have to invest in. If not, you should not invest into. So this is in nutshell. So due to these decisions, the share value of the company has increased from $172.5 when Warren Buffett invested to $592 630 per share in 1993. So this is a nutshell. So now comes the question, many people have, speculated that Warren Buffett has done a very bad decision is in purchasing such kind of a stock. Why that he had taken that bet? So when people asked, what is the reason why you have purchased it so he said only one thing. It is only because of Murphy and Burke he has bet on this particular company. So you always have to remember, always have to bet on a manager who has a very excellent credentials. At the same time, he is very frank, open-minded, and he is basically capable managing. So these are the traits we have to look forward for any kind of making any kind of investment into a company. Then this is a very interesting case study. It's a Coca-Cola company. I don't think it needs any introduction. Everybody knows about this giant brand, which is one of the leading brands in the world, which is ubiquitously present throughout the world. Every nook and corner, you find Coca-Cola products. So it was, the story is very unique, and Warren Buffett happened to have associated with this company since he is 6 year old, and his business started with selling of Coca-Cola cans or to his friends when he was 6 year old. So that was the time he started business, and the business is started with Coca-Cola. However, it took him more than half a century or more than 5 decades for him to invest into Coca-Cola company. It started in 1998 when he started buying in a big way, and it was then the CEO of the company, Kyo, he made a call to Warren Buffett to ask that somebody from Midwest is trying to purchase our stocks, and are you aware about it? So he started, was laughing and giggling, and then he told him quietly that please don't disclose it till I disclose it officially. So that is when in 1999 Warren Buffett have spent more than $1 billion purchasing Coca-Cola stocks, owning around 7% of the company's stake, and which happened to be the single largest investment till date. And for that, he had to pay 5 times the book value and over 15 times the earnings of the company. And the premium, he had paid premium over the stock market price. So why did he do it for a 100-year-old company which sells just a soda pop? And many people have expressed doubts about the wisdom of Wizard of Omaha, and they even doubted whether he is a did he gone mad or what. And anyway, well, let's discuss whether what he has taken, the decision is that prudent, is it right or wrong? That we will discuss in this case study. So now let's try to understand what Coca-Cola is. Coca-Cola is the world's largest beverage company. It sells more than 500 different sparkling and still refreshments in over 200 countries worldwide. And out of 500 brands, there are 15 brands which are billion-dollar brands, including Coca-Cola, Diet Coke, Fanta, Sprite, Vitamin Water, Powerade, the Minute Maid, Simply, Georgia, Del Valle, and Buffett's relationship, as I said, dated back since his childhood when he is 6 year old. And then he started selling Coke bottles to his friends. So for 40, 50 years, he have been observing the Coca-Cola reaching, heights, and in fact, it was growing phenomenally. And whereas Warren Buffett instead, focusing on textile mills, departmental stores, and then farm equipment. And even in 1986, when he formally announced that Cherry Coke would officially become soft drink of Berkshire Hathaway, still he did not purchase Coca-Cola. It was till 1988 he didn't purchase any share of that company. So now let us see the tenants, whether the what are the tenants, whether he has applied all those tenants or not. And this is a case study when I will, show you how to derive valuation, how to evaluate a company. And in all three, there are three scenarios. All three scenarios will be explained in this particular case study. The business of Coca-Cola is very simple and relatively simple. The company purchases commodity inputs, mixes them to manufacture something called as a concentrate. That concentrate is sold to the bottlers. Bottlers, in turn, will combine with water and other concentrates, and then they bottle it. Finally, they sell it to the retail outlets, which includes mini markets, supermarkets, vending machines, and then these days even the company is also selling them to the restaurants and fast food retailers. So who basically sell these soft drinks in either cup or in a glass. So and now the next tenant, let us see whether they have a consistent operating history. And you can say there is no other country company that can match Coca-Cola's consistent operating history. Ever since 1886, it started selling the first product, and over a period of almost 140 years, right? Coca-Cola has grown much big. Now it is one of the mightiest brands the world has ever seen. And today it is selling somewhere around 1.7 to 2 billion dollar, 2 billion servings daily. And it's a provider of, beverages, ready to drink coffee, juices and juice drinks. So this is you can say the progress of this company. And however, it only sells colas, only bottled drinks, nothing more than that. Only single product. Now let us see what are the favorable long-term prospects. And then it was, uh, in fact, indeed, when he purchased in 1989, he owned 6.3 percentage of Coca-Cola company. Then he was interviewed by a business writer for Atlanta Constitution, Melissa Turner, and she asked Warren Buffett, why haven't you purchased this company sooner? By and then they see the Warren Buffett's answer. He say, let's say you are going away for 10 years, and you wanted to make one investment, and you know everything that you know now, but you couldn't change it while you are gone. What would you think about? So now the the reason or the crux why he has purchased that is, of course, the business would have to be simple and understandable. Of course, business would have to be demonstrated a great deal of business consistency over years. And of course, long-term prospects would have to be profitable. If it came up with anything in terms of certainty, where I knew the market was going to grow, where I knew the leader was going to be the leader, I mean worldwide, and where I knew there would be big unit of growth. I just don't know anything like Coke. That is what he explained. I would be relatively sure that when I come back, they would be doing a hell a lot of more business than they do it now. But the purchase at a particular time, Coca-Cola's business attributes, as described by Warren Buffett, had existed for several decades. What caught his eye, he said, were the changes occurring in the Coca-Cola during 1980s under the leadership of Roberto Guzziotto, chairman and CEO, and president uh, Donald Keogh. The change was critical and overdue. So that is the reason why, because there was a change in the management, it prompted him to go for Coca-Cola. Coca-Cola during 70s, prior to Guizziotto coming to power, taking the reins. It was, that 1970s had been a dismal years for Coca-Cola, decades marred with a lot of disputes with bottlers, and then accusation. of mistreatment of migrant workers, and environmentalists crying foul about growing pollution. Then Federal Trade Commission charging company exclusive franchise system violating the Antitrust Act, Sherman's Antitrust Act. And Coca-Cola's international business was also reeling because Arab had already boycotted Coke and began when the company had issued an Israeli franchise dismantled years of investment, and Japan, where the company is growing very fast, had been a battlefield of corporate mistakes. Coke's 60s 26-ounce take-home bottles were exploding literally on the store shelves. In addition, Japanese consumers angrily objected to company's use of artificial coal tar coloring in Fanta grape when the company developed a new version using real grape skins, and the contents fermented and grape soda was tossed into Tokyo Bay. This was a situation or the crisis in which Coca Cola was into. So that had dented the value of Coca Cola. And then Coca-Cola in 1980s was a fragmented and a relatively reactive company rather than innovator settling the pace with the beverage industry. Despite its problems, company continued to generate millions of dollars of funding. But instead of reinvesting Coca-Cola's own beverage market, Paul Austin, appointed chairman in 1971 after serving as president since 1962, so decided to diversify. He invested into water projects, shrimp farms, despite their thin, slim profit margins. He also produced a winery. The shareholders bitterly opposed to this move, arguing Coca-Cola should not be associated with alcohol. To deflect criticism, Austin directed unprecedented amounts of money for advertisement campaigns. Meanwhile, Coca-Cola earned 20 percentage on equity, but pre-tax margins were slipping. And the market value of the company at the end of the bear market in 1974 was 3.1 billion. So 6 years later, the value had increased to 4.1 billion. In other words, from 1974 to 1980, company's market value increased at an average annual rate of 5.6%, is significantly underperforming S&P 500 index. So for every dollar company retained in 6 years, it it created only 1.02 in the market. So it is faring quite badly. So this was in a very huge crisis. That is where Warren Buffett found, a kind of a, what do you call, opportunity in purchasing this particular share. So Coca-Cola's corporate woes were exacerbated by Austin's intimidated and unapproachable behavior. To make the matters worse, his wife Jane was a disruptive influencer within the company. She redecorated corporate headquarters with modern art, shunning the company's classic Norman Rockwell paintings and even using corporate jet for her art buying trips. But it was her last order that contributed to her husband's downfall. So in 1980, Mrs. Austin ordered companies park close to employees' lunchbox. This sparked a kind of a rebellion within that particular company. Their food droppings, she complained, attracted pigeons on a well manicured lawns. Employees' morale hit all time low. Robert Woodruff, the company's 91-year-old patriarch, who had led Coca-Cola from 1923 till 1955 and still chairman of the board's finance committee, had heard enough. He demanded Austin's resignation and replaced him with Roberto Coizzuto. Coizzuto, raised in Cuba, was Coca-Cola's first foreign chief executive officer, and he was an outgoing as Austin was reticent. One of the first acts was to bring together Coca Cola's top 50 managers for the meeting in the Palm Springs, California. And he asked, tell me, where what we are doing wrong. He said, I know, I want to know it all, and once it is settled, I want 100% loyalty. If anyone is not happy, we will make you a good settlement and say goodbye. From this meeting evolved company's strategy for 1980s, a 900-word pamphlet outlining corporate goals of, for Coca-Cola. Koizumi encouraged his managers to take intelligent risks. He wanted Coca-Cola to initiate action rather than to be reactive. He began cutting costs. He demanded that any business that Coca-Cola owned must optimize its returns on assets. These actions translated immediately into increasing profit margins. So now the next tenets. Uh, the tenet is high profit margins. 1980, Coca-Cola's pre-tax margin was as low as 12 point, you know, it is 12.9 percentage, whereas the margins have been falling straight years and were substantially below the company's 1973 margins of 18 percentage. In Goiziato's first year pre-tax margin rose to 13.7 from 12.9, and by 1988 when the Buffett bought his shares, the margins climbed to record 19 percentage. So there was a substantial improvement in the profit margins, and this is one of the tenant and trait we need to observe from the companies which are outperforming its past records. So now let us see the other tenant. That tenant is called as return on equity. In strategy for 1980s, Koizumi pointed out that the company would divest any business that no longer generated acceptable returns on equity. Any business venture must be sufficient real growth potential to justify an investment. Coca-Cola was no longer invested in battling for share in a stagnant market. Increasing earnings per share and affecting increased return on equity are the name of the game, Goizotto announced. His words were followed by actions. Coca-Cola's wine business was sold to Seagram in 1983. This is a game changer. Actually, he wanted to, focus only on the core businesses and to sell off all the, spin-offs or non-core businesses. And he don't want to battle any kind of a stagnant growth. He want increase in earnings per share as well as increase in return in equity. So actually, once he has decided what will be the course of action, he steadfastly followed it, and that was followed by the initial thing is like, a company sold its wine business, and then later in 1983, so the company's return on equity was 20 percentage in 1970s, which Goizioto was not at all happy with, and now by 1988 the return on equity has increased to 31 percentage, which is by any standards very very high. So by any measurement, the company's Goizioto's Coca-Cola was doubling and tripling the financial accomplishments of Austin's Coca-Cola. The results could be seen in the market value of the company. And in 1980, the value was 4.1 billion. By the end of 1987, the stock market crashed in October. The market value has risen to 14.1, which is around 2.5 times increase. And in just 7 years, Coca-Cola's market value increased at an average annual rate return of 19.3 percentage, which is by any standard very huge. And for every dollar Coca-Cola reinvented or reinvested or retained during this period has given 4.66 dollar in market value, which is 4.5 times the investment. It's huge. Excellent. So now let us see the tenant called as candor. Candor means openness and frankness. And how open and frank the management is. Management here means CEO or the chairman, whosoever, depending on the country and context. So Goizuoto, Goizuota strategy in 1980 pointedly included shareholders. So what he said is we shall during the next decade remain totally committed to our shareholders and to the protection and enhancement of their investment in order to give our shareholders an average, above average total return on the investment, we must choose businesses that generate returns in excess of inflation. So he made it clear what is his, commitment and what is the returns he would be giving it to the shareholders. He wanted to give returns in excess or in excess of inflation. So he not only grow the business, which required capital investment, but also was obliged to increase the shareholder value. So he had a twofold job, or you can say mm, the mission. The mission is twofold. One is to do a requisite capital investment and also to increase the shareholder value. Shareholder value will increase either by giving them dividends or increasing the value of that particular share. So these are the two. It was a very challenging task for him. To do so, Coca-Cola, by increasing profit margins and returns on equity, was able to pay dividends with substantially reduced dividend payout. And this is a very important thing. Like what he did is he reduced the dividend payout ratio, but he started increasing the amount of dividend. That was only possible when the profit margins and return over equity has increased. So he ensured with the increase in profit margins and return over equity, he could reduce the payout ratio and retain more money. At the same time, he has reinvested into the business. So the payout ratio has declined from 65 percentage to 40%, whereby previously the retained earnings were 35 percentage of the whatever total net income, whereas at the later stage it has increased to 60 percentage, right? And while he has consistently started increasing the so-called dividend actual the you can say the uh, absolute number, in terms of absolute numbers, there is an increase in dividend, so is the percentage wise it is increased, but however retained ratio got reduced. So this enabled Coca-Cola to reinvest a greater percentage of the company's earnings to help sustain the growth while not short changing shareholders. So under Goizioto's leadership, Coca-Cola's mission became crystal clear. Management's objective was to maximize the shareholder value over time. To do so, company focused on high return soft drink business. If successful, the evidence would be an increase in the growth of cash flow and increased return on equity, ultimately increased return to the shareholders. This is the reason whether, see, this is all about whether the leader is committed to the shareholders, whether that commitment is translating into actions, whether that actions are leading to increase in the shareholders value. These are the three things which is easy said than done. It's quite challenging, and Goizueta has proven he is very worthy and he is very capable and he is highly committed. So that was one of the reason why Warren Buffett has preferred to purchase Coca-Cola as a company. Rational management. The growth in net flows not only allowed Coca-Cola to increase its dividend to shareholders, but also enabled company to initiate its first ever buyback program. In 1984, Goizueta announced that the company would repurchase 6 million shares of stock in open market, and repurchasing stock is rational only if intrinsic value of the company is higher than the market price. This is a very, very important, condition. You all need to understand this, and no one should forget this. So, repurchasing a stock, okay, is rational only if the intrinsic value of the company is higher than the market price. If it is lower than the market price, never, that's not a good decision by the company, and you should not, rather, you should sell the company stock and take a buyback rather than staying in that company. The strategic changes initiated by Goizuoto with the emphasis on increasing return on equity for shareholders suggested to him that Coca-Cola had reached that tipping point. So now let us see the next important part, the owner's earnings, whether they are increasing or not. In 1973, owners' earnings were 152 million dollars, whereas by 1980 it increased to 262 million dollars, which is 8 percentage compounded annual rate. And between 1981 to 88, in the 8 years span, owners' earning grew from 262 million to 828 million, which is a 17.8 percentage compounded annual growth, which is very high. So that is the reason why Warren Buffett has chosen it. And apart from that, there is one more thing which Buffett might have tracked to, and which is not mentioned in this particular case study. It is that is the time when the world was opening up. There was a negotiations during Uruguay round of GATT. So there was a talk about privatization, globalization, and liberalization. So the American MNCs were extending into the newer markets, be it Europe, be it Africa, be it Latin America, be it Asia, and the expansion has encouraged him to take certain decisions, and Coca-Cola was one of the largest beneficiary in this particular globalization phase. So that is the right time when he has taken a decision to purchase Coca-Cola stocks. So from the growth in the owner's earnings was reflected in the share price of Coca-Cola. And from 1973 to 1982, the one decade period, the Coca-Cola grew at an average annual rate of 6.3 percentage. Whereas under Goizueta, it increased, the annual return has increased to 31.1 percentage, which is huge improvement compared to the past. So now let us see the tenet institutional imperative, which is again about the managerial decisions. So again, when Goizueta took over as Coca-Cola chairman, one of the first moves was to, sell off all those unrelated businesses that Paul Austin had developed, and the return the company to its core businesses, just selling syrups. Okay, it was a clear demonstration of Coca-Cola's ability to resist in institutional imperative, reducing the company to a single product business, which was a very, very bold decision, which is highly uncertain whether it will be successful or a failure. And when he made a strategy which was even more remarkable, was his willingness to take action at a time when others in the industry were doing exactly opposite. Like they are going into unrelated businesses. So like, Anheuser-Busch, which is a beer company that manufactures Budweiser, they have entered into theme parks, whereas Brown Froman, producer and distributor of wine and spirits, They invested into China, crystal, silver, luggage businesses, all of which were very low return businesses. Seagram, global spirit and wine business, they bought Universal Studios, which is totally unrelated. Pepsi, the Coca-Cola's chief rival, they bought snack businesses, Frito-Lay, restaurants, which includes Taco Bell, Kentucky Fried Chicken, and Pizza Hut. So it is important to note that he was doing something which others are, something which is opposite of what the industry is doing. So everybody was skeptical whether the decision taken by him is right or wrong. However, because of economic returns of selling syrup far outweighed the economic returns of other businesses, company was now reinvesting its profits into highest return businesses. So this is the wisest ever decision taken by the shareholders of not shareholders by the managers of the company. Now let us see how do you determine value. See, this is one of the most interesting case study as we discussed. So, how will you calculate the value of this particular, Coca-Cola industry? So, yeah, and everybody has said that, this Warren Buffett, who happened to be a wizard, he has gone berserk and he gone mad and crazy, purchasing Coca-Cola at 15 times its earnings, 15 times its cash flow, and 30 to 50% premium to the market average. So everybody thought that Buffett is doomed. Totally, he's taking a very wrong kind of a decision. And then uh, this is a nutshell about it. Then the company was earning around 31 percentage on equity while employing relatively little capital investment. So what Buffett explained, why did he purchased it, is that the value of Coca-Cola is like that of any other business, is determined by total earnings expected to occur over the life of business, discounted by appropriate interest rate. This is a very important decision about how to calculate the value. It is determined by the total owner's earnings expected to occur over the life of the business, discounted by appropriate interest rate. So that we will explain it further. So in 1988, the owner's earnings of the Coca-Cola equaled 828 million. And at that time, 30-year US Treasury bond risk-free rate was trading at around 9 percentage yield. Coca-Cola's 1988's earnings discounted by 9 percentage would produce an intrinsic value of 9.2 billion. So this is 9.2 billion, and I'll just show you how it is being calculated. And then when Buffett purchased Coca-Cola, the market value was 14.8 billion. So he has, at the first glance, everybody said that Warren Buffett has purchased at 60% premium over the actual intrinsic value. So everybody said that he has gone mad. So let us see how it is being calculated. So this is the earnings on that particular date. The earnings of the company Coca-Cola is 828 millions, whereas the risk-free interest rate 30-year US Treasury bond rate is 9 percentage. So taking this into consideration, intrinsic value, as as per the formula, it is 828 million, 8 to 8 million, which is the cash flow for that particular year, divided by 9 percentage, which happened to be the rate of risk-free rate. So it is 900. That is almost 9.900 9,200 million. So which is equivalent to 9.2 billion dollars. So market price is 14.5 billion. So let us see what is the premium he has paid. So let's do the calculation. This you just take 14.8 percentage, sorry, 14.8 billion minus 9.2 divided by 14.8 divided by 9.2. It is 60.87 percentage. So this is how people have derived that he has paid 60.87 percentage market premium. So this is the valuations which we have got. This is a simple formula which generally we tend to use. However, there is a difference in how you have to value Coca-Cola that we will be discussing very right now. So after this, certain things are to be taken into consideration before considering this. So what Warren Buffett observed is during the decade 81 to 88, Coca-Cola has grew at 17.8 percentage faster annual rate than risk-free return. Okay, which is higher than risk-free return rate. When this kind of situation occurs, you have to go for a two-stage discount model. Okay, how you will calculate that, I will explain it at the later stage. But here there are certain things. In 1988, the owner's earnings are 828 million. Then whereas there are two, three assumptions, if you assume two, three different assumptions, then you'll get a different kind of a calculations. If you assume it to be growing at a 15 percentage rate of interest for next 10 years, and which is reasonably possible, and it is a reasonable assumption based on the way the company is expanding and the as I mentioned, because of globalization, where the MNCs have started expanding to other markets like Europe, Asia, then Latin America and Africa. So they were giving much better returns, and it is anticipated that Coca-Cola, due to its global presence, definitely will increase and expand its business, and it will grow much faster. So due to that, if it grows at 15 percentage, which is said to be a reasonable assumption, the at the end of 10 years, it would increase to 3.349 billion. So, however, since there is a discounting factor and you have to make a calculation of so-called present value, when you are going to calculate present value, you have to take a discounting factor. Discounting factor here is 9 percentage, which happened to be the long-term bond rate at that time. So there they have given, from 11th year, say, suppose there is a slowness in growth, and which is 5 percentage per year, which will grow perpetually at this particular constant rate. Then using a 9% discounted rate, we can calculate the intrinsic value of the company as 48.377 billion. Now the question is, how did you arrive at this particular value? So I'll show you the calculation. Now let us see how it needs to be calculated. So when the value model will be two-way model, in which in the first year you have you in the first phase you assume that for 10 years from then the value of this particular company is going to grow by say 15 percentage constantly every year. So what you do is the compounding factor will be 15 percentage. Here I have mentioned it as CF. CF is compounding factor. DF is basically discounting factor. Discounting factor is US Treasury bond for 30 years, which is at the time, 9 percentage. So I have taken that. So 828 is the earnings at that particular period in 1988. So for the next year, like I have calculated for 10 years, what I did is I have taken this, you know, I have multiplied this with the constant, the so-called compounding factor. So I multiplied this initial, the so-called owner's earnings into the 1.15 factor. So it became this. And in the next year, I multiplied the same amount with again the compounding factor 1.15. So I continued this till the 10th year. So as it is mentioned in this particular case study, the value at the end of 10th year would be equal to 3.349 billion. So this is how you have calculated 3.349 billion. So but however, the story don't end here. You have to calculate the net present value because you are trying to find out what is the present value of that particular investment at the end of 10 years. It may not be 3.39 because of the inflation and the other factors. The NPV, the present value, keep on depreciating. So what is the formula? So what I did is I have taken the this compounded value, at the end of first year, I divided it by this 1.09. So in after this, what I did is again I have taken this value and I divided it by the discounted value because discounted cash flow, it depends on number of years. So the more the number of years, that many times you have to divide it. So this in this particular case I divided it by 3 times. You can just see 1 2 3 times, and in case of the next I have divided it by 4 times, 1 2 3 4. And in case of this, it is divided by 10 times, 1 2 3 4 5 6 7 8 9 10. So finally this is the value which is derived. So this is the present value at the end of 10 years, with the compounding factor of 15 percentage. So the intrinsic value will be the addition of terminal value. Terminal value is calculated based on the intrinsic value which we have seen, the cash flow into the growth, and divided by the rate of return minus growth. Here R equals to 9, which is risk-free return 9 percentage, whereas the growth is 5 percentage. So if I add that, I'll just show you for the convenience of all. See, this is the current the present value of the cash flow into the growth factor here is 5 percentage. So 1.05 being 5 percentage, it is 1.05 is the factor. So now you have to divide this by R minus G. R here is 9 percentage within bracket 9 percentage minus, again here it is G is growth is 5 percentage constant growth. So once you divide this with this, so you got 37 billion. You have to add the terminal value with already in this particular 10 years, there is some, cash flows which is generated by the business. So you have to add all these 10 years cash flows, which is a present value of cash flows, not that, the compounded value. You have to take it only a net present value. So once you have taken this, what I did is I have just added, rather I have aggregated it. I had summed it, sum of all these 10 years. So from here till here, whatever the amount is derived, this I have got it as a sum. And finally, I have arrived at a intrinsic value of 48,392,711. So let us see what is the value they have obtained. They got it as 48.377, whereas I got it as 48.392, maybe a little, rounding off figures because I didn't round off. So it was maybe that the rounding of error is there. Otherwise, it's almost the same. So now let us go to the next. See, he has given another scenario. What if, assuming that if not 15 percentage, if it grew only at 12 percentage, assuming that there is some economic downturn and the conditions were not favorable, then what would have been? So I just made a calculation also. Here, instead of compounding factor as 15 percentage, you change it to just to 12 percentage. You just change the numbers. So it became 38.157 billions. So let us see what is it here. So here it is shown as 38.163. And what did we get? 38.157. So it's almost near with a little rounding of errors. And then now, if at all, say in another scenario, let us assume that it is not growing at 12 percentage as assumed. It is only growing at the rate of 10 percentage. In that scenario, what would be the intrinsic value? So you just replace this 12 percentage with the 10 percentage. It is somewhere around 32.522 billions. Say here 32.497. So more or less it is very much near to that value. So at this rate, it would have been, even better than what is the current value. Current market value is 14 billions. Now, there was another assumption. What if it is only growing at 5% throughout instead of 10% for 10 years or 12% for 10 years or 15% for 10 years? So what is the value? So in that scenario, they have calculated it to be 20 point. See, I'll just show you. This is 869. This is the current cash flow, and then the rate of growth is 9 percentage. Okay, sorry, 9 percentage is your risk-free return, and 5 percentage is the constant growth. So the value of that particular thing is $20.7 billion. Still, if you take all these scenario into consideration, still the the purchase price by Warren Buffett is cheaper compared to the market price. So this is a nutshell. So whether he has purchased at an attractive price. So naturally, if you take all these into consideration, he has purchased at an attractive price. Now, the logic behind it, because everybody thought that he has given at a higher price. Let us see what is the logic he has taken. In June 1988, the price of Coca-Cola was approximately 10 per share, and over next 10 months, Buffett acquired 93.4 million shares for a total investment of 1.023 billion. His average cost per share is 10.96, and at the end of 1989, Coca-Cola represented 35% of Berkshire's common portfolio. From the time Goizueta took control of Coca-Cola in 1980, the company's share price had increased every year. In 5 years before Buffett purchased his first shares, the average annual gain is 18%. The company's fortunes were so good that Buffett was unable to purchase any shares at distressed prices. Still, he charged ahead. And please remind us, has nothing, he reminded us that has nothing to do with the value. The stock market value of Coca-Cola in 1989 and 88 and 99 during Buffett's purchase period averaged 15.1 billion. So, but the Buffett's estimation, the intrinsic value of the company was anywhere from 20.7 billion to 32.8 billion, assuming 10% growth or assuming 5% growth, and 38.1 billion assuming 12% growth, or 48.3 billion assuming 15% growth. Buffett's margin of safety, the discount to intrinsic value, could be as low as 27 percentage to as high as 70 percentage. So, in Buffett's own words, best business to own, Buffett says, is the one over a long period of time can employ ever large amounts of capital at sustainable high rates of returns. In Buffett's mind, this was a perfect description of Coca Cola. 10 years after Berkshire began investing into Coca Cola, the market value of the share had grown from 28.5 billion to 143 billion. And over the period, the company produced 26.9 billion in profits and paid out 10.5 billion in dividends to the shareholders and retained 16.4 billion for reinvestment. For every dollar the company retained, it created 7.2 dollars in market value, which is very huge, 7.5 times, 7.2 times. At the end of 1999, Berkshire's original 1.023 billion worth of investment in Coca-Cola was worth 11.6 billion, which is 11 times more than what he has invested. So over a period of time, it increased by 11 times, which is huge by any standards. The same amount invested in S&P index would have given only $3 billion. That is what is, Warren Buffett. And that is where we need to learn from him. There are so many other case studies, around another 5 case studies, but however, since due to paucity of line, and we may reiterate, or rather we talk about the same things again and again instead of repeating all these other 5 case studies. We would now like to understand what is the common theme which is in this entire of the thing, which we all as an investors, as a learners of investment, what do we understand by it? The common theme is that Warren Buffett was never under in any hurry to sell any of the stocks. Even if the stock he purchased is doing very well, and then the short term appreciation doesn't interest him. To illustrate further, I'll show you the power of compounding, right? So I think it will make it very, very clear. Suppose the compounding factor, instead of being 10 percentage, let us start from it from sorry say 0.1 percentage. Say from the 1 percentage, if it is 1 percentage, the intrinsic value would have been only $15 for this particular company. And the 828 so-called million would have, at the end of the year, at the end of 10th year, it would have been 914 million, very marginal increase. So now let us change it to 2 percentage from 1 percentage. So if I change it to 2 percentage, you just see the change. So it has increased by another 1 billion. It's a huge increase. So now let me make a change to from 2 percentage to 3 percentage. And then now see another 1 billion has increased. Now let me make it as 4. Another 1 billion is added. So 5. One more billion, right? Six. Okay. And then it's increasing, or rather, I will do this way. Okay. Let us put it as 100 rupees, right? I think it would be better. Say if it is 100 rupees, what would be the returns after a period of 10 years, right? After a period of 10 years, every 1% would yield only 110, and if it is 2%, it will be 21% increase. Just imagine if it has grown by 3%, it is 34% further growth. Then if it is 4%, 14% sudden increase. Then if it is 5, then it is 162. And then see it, you what you find is something like a kind of exponential growth. Now let us increase it to 6. If it is 6, 179, right? And if it is 7, 196. See the growth, phenomenal growth. With every 1%, it is growing like, crazy. So if you increase it to 9 percentage, see again 238. If you increase it to 10 percentage, 259. Let us increase by 5 percentage instead of going 12 percentage, 15 percentage. So it's 404. 4 times it has grown. And then if it is 16 percentage, 16 percentage 444. Now let's put it as 20 percentage. 619. What if it has grown, say instead of 20, the company has grown 25 percentage? What would be the compounding value? It has grown 9 times. And if it is 30, it is 13 times. And if it is 35, it is 20 times. If it is 40, so it is growing 28 times. And there is no end to it. You can keep on checking with this particular simple table, and you see there is a huge amount of change when you change from one position to the another. And you can keep on checking what is how this power of compounding. And the reverse is also true. If you reduce the percentage, if you depreciate the same reverse, I'll just show you. Say you have depreciated it by say 0.1. Okay. See the change in numbers. With the increase in percentages, the change in the numbers will not be as much as the reverse, the compounding. So this applies even to the stock markets. So whenever the stocks keep falling, the pinch or the reduction in your overall value will be lesser with further reduction. Whereas when it comes to the stocks, there is no upper limit. Sky is the limit. When it comes to downward limit, it is 100%. Whatever the maximum losses you may incur is 100%. Beyond that, there will not be any loss. But when it grows, it grows many times than what you have invested. Suppose, let us assume you have invested, suppose 100 rupees, and it became 10 times, which is possible with many companies, say after 10 or 15 years. So say 5 percentage a company has this particular company has grown, which is possible. So 5 percentage increase over 1000 is basically 50 rupees, whereas you have invested only 100 rupees. So for 100 rupees investment, what is the increase in the growth? That is 50 percentage growth. Suppose let us take the reverse of it. Suppose you have purchased a stock at 100 rupees, and right now the value is 50, and it has reduced by 5 percentage. So 5 percentage of 50 is 2.5, whereas your investment is 100 rupees, And for 100 rupees, the reduction is only 2.5. Let us assume the other way around. Suppose you have invested 100 rupees and it became 10 rupees. So it has reduced, further reduced by 5 percentage. 5 percentage of 10 rupees is zero point 0.5 paise. So 5.5 rupees or 50 paise. So 50 paise of 100 rupees is 0.05 percentage. So this is the difference between the compounding factor and a discounting factor. So this you need to apply to your stock trading. So understand this concept very well. That will make you understand. That is the reason why never sell any good stock, whichever you are having. So never be in a hurry to sell it. The more the hurry, see, suppose you have sold it, say you got some 30 percentage, appreciation in that particular thing, and then you booked a profit. And for that profit, if it is a short term capital gain, you have to pay 15 percentage tax plus all other taxes and all, expenses including. You will be losing somewhere around, 20 percentage. So your net gain is only, say, out of 30 percentage, like 100 rupees you have invested, out of 30 percentage, you are again losing somewhere around, 20% at, say, 20 percentage of it. So your take home is just 80 percentage of 30, which is around 2.24 percentage is the profit you have booked. Again, suppose you want to again re-enter the same stock, assuming that you came to know that that is a very good company and it is going to grow even further. So ultimately what happened? You have already, invested, and you will not get at the rate of 100 rupees. Now maybe you have entered the market at 200 or 300. Say you have entered at, say, 300 rupees. From 300 it slowly appreciates, it became 400. Had you had the same at the rate of 100, so the appreciation would have been 3x. Now your appreciation is hardly 1.3x, or rather, sorry, 0.3x. So this is the reason you should never sell it. And if you hold it for very long, the appreciation will be very, very high and you will be benefited. You need not pay any tax. There will not be much outgo. There are not much of transaction costs. So better avoid going for short term trades. And as I always quote SEBI, based on the SEBI study, 95% of people who do short term trade, they all end up in losses. So understand this. And next is Philip Fisher has taught him one thing, and which we can also use it. See, either your investment is better or better than the cash, or it is not. When you hold it cash, you mean what it means by cash is, if you put the cash into, say, any bank account, and then the amount of what is the return you will be generating, 7.2. So any investment whichever is giving less than 7.2% returns, that is a very bad investment and there is no point investing into it. And when you are investing, you ensure that you are getting more premium than what a bank account is giving or bank interests are given, right? So always, because see, as we have discussed in the second or third session, there is during risk and return, it is very clear the equities are very high risky investments. If the equity is high risky investment, naturally the return should be higher. Otherwise, there is no point wasting your money. Instead, you better put it into bank and get whatever the fixed income, fixed interest you will be getting. And however, it's not at all, it is also true that not all the investment into stocks will give you that much of return. There are very few stocks or very few companies that give you a very good rate of returns. So you be very mindful of these kind of investments. Now, the next thing is, next tenet, Buffett always says, quite content to hold any security indefinitely as long as the prospective return on capital of the underlying asset is satisfactory, management is competent and honest, and the market does not overvalue the business. Now you recognize the tenets. Now let us go back to, see, if you understand, as long as the prospective return on equity capital of the underlying is satisfactory. So what is the tenet? It is following the financial tenet, return on equity. So first tenet is that, and the second, once the return on equity is given, naturally that stock is definitely, will give more earnings to the owners. So the second fundamental is taken care of. Then the third is, for every retained earning, it will give more than, for every dollar in reinvested, it will give more than $1. So three fundamentals are covered. And the fourth one is, he talks about management is competent, honest. So management, when they are competent and honest, they will take rational decisions. They will resist the institutional imperative, and also they will be honest and very, that candor part of the management, whether they are honest with their shareholders. So all these things, apart from that, market does not overvalue. So you are going to, the valuation of the company, the principle of valuation, and also there's discount for what you are paying for. So it is taken care. If you see the other part also, the so-called in the business, like, it is when you are holding it for very long, that means it has a very, first thing, business is simple and understandable. It is also indirectly, if not directly. Then the second one is it has a consistent track record, is the second. The third is that, you know, wait, let me see that. Third principle is, does the business has a favorable long-term prospect? Yes, of course. Otherwise, he would not hold it for very long. So, and again, it will also give increased profit margins. So, everything is explained in one particular statement. So, you just remember this statement. That statement will make you understand the entire gamut of this, business principles which he generally apply. And then he also reminds shareholders that his favorite period of holding is forever. And okay, once he said you have to hold it forever, then now comes, whether is it rational to buy a stock and keep it forever? What do you think? Should you do that, or should you manage a portfolio? This is what is the topic for discussion in future to come. And stay tuned. With this, I wish you all good luck, and we will meet you soon for the next series and next episode. Thank you very much. Good night.